Welcome to Know More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to Know More, Risk Better, a CreditSights podcast. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy here at CreditSights, and I am delighted to be joined by our head of utilities and power and head of investment grade, Andy DeVries. Andy, thank you so much for coming back on the podcast.
Thanks, Zach. Great to be here.
All right, so for those of you that haven't heard Andy before, he is dialed into everything utilities, which is basically everything data centers now. Andy, you recently attended the Edison Electric Institute, or EEI Investor Conference, and said it basically doubled as a data center conference. So first, what is the Edison Electric Institute, and can you maybe paint a picture of the conference for those that weren't able to attend? I assume this was mostly an equity investor conference, is that right?
Sure. So Edison Electric Institute is the trade lobbyist for electric utilities, and electric utilities know how to do a lot of things really well. One is keeping the lights on, and two is lobbying. And so this is their lobbyist organization. They have an investor conference every November. This was the 60th annual. So, over 1,000 people were there. Most of them were investors, and then all the utility management teams.
I understand this was maybe a little bit more of a production than it has been in previous years. Is that fair to say?
Yeah, I think you read our note, and we said essentially doubled as a data center conference. And in case anyone had any doubt that we're going to overbuild data center capacity, CNBC was there broadcasting live from the floor of the main ballroom. And it was just every single conversation was data center this, data center that. Utilities historically have grown earnings 5 to 6% per year, EPS 5 to 6% a year. Now they're up to 6 to 8%. Some of them are pushing 7-9%. And this is data centers are the main drivers of this.
I think that's a great framing for, I think utilities are generally thought of as relatively sleepy credits. Is that fair to say? And now there's a big thematic driver going on, taking things maybe outside of the historical norms, at least in terms of profit growth.
Exactly. So, water is wet, the sun rises in the east, and utilities are defensive credit. I mean, they have no exposure to a slowdown for the economy. There's no exposure to a recession. They're just a defensive credit. That's what they are. But now the whole narrative has changed. They're a growth story here. And that's why you've got a lot more investors at this conference than normal. So a lot of clients we had couldn't get rooms in the main hotel. They had to stay several blocks away. And it was just a very, very bullish conference.
All right. So your takeaways report highlighted your view that we are unequivocally in a data center overbuild situation, but not many folks are talking about it or perhaps worried about it. And to me, that sounds a lot like the AI-driven economic and financial market performance in 2025. Can you give listeners a little bit more detail on your overbuild view?
Yeah, so, Zach, you know me. I have a lot of views on a lot of things. I have a lot of opinions. I have a lot of strong opinions. But this is just math, just plain and simple math.
You can't fight the math.
You don't fight math. It's always right. It always wins. So you look at the third-party estimate. First of all, you can either go from capacity, which is gigawatts, or you can go to output, which is terawatt hours. There's 8,760 hours in a year. You can round that up to 9,000 and just use 0.9 to go back and forth. But for simplicity, I'll just stick it on capacity here. So right now, the U.S. is consuming around 35 gigawatts of data center power. There's a lot of estimates for 2030, and they all are pretty tight around 85 gigawatts. Bloomberg New Energy Finance, very well-staffed, well-researched organization, just came out with 81 yesterday. So 85 is where you need for 2030. There's a lot fewer estimates for 2035, but Deloitte sort of anchors those. You're at 165. So subtracting that where you're at now, the 35 from 85, you need 50 gigawatts more data center capacity from here to 2030 and 135 going out to 2035. So 50 gigawatts and 130. That's what the growth is. Those are the third-party estimates. Yeah, that's the growth.
All right.
Then we had Diego back in the office track all the utilities data center backlogs. And so there's two aspects here. There's the firm and committed, i.e. you're going to get built right here, right now. And then there's the pipeline behind that. The pipeline has a lot of triple, quadruple counting in there. So if you're a big tech and you need to build a data center in the Southeast, you're going to tell Georgia Power you want to build one. You're going to tell Duke Carolinas you're going to build one. You're going to tell Dominion South Carolina you're going to build one. And only one's going to happen. So the pipeline is a little bigger. But here are the numbers. Utilities right now, 130 gigawatts of firm and committed connection requests and 700 pipeline. So let's ignore the pipeline and look at just the 130. Now, when you connect to the grid, there's a lot of things besides compute. So you've got liquid cooling, you've got fans, you've got electricity, you've got all sorts of other power demands. So you've got to take these utility estimates and adjust it for the power usage efficiency, the PUE. So right now you're on 1.4, you're going to 1.1. Let's just use 1.3 to keep it simple. And that 130 then drops down to 100. That 700 drops to 540. But remember, between now and 2030, you only need 50. So the takeaway is utilities are already tracking twice as much data center capacity as you're actually going to need from 2030, and then even more with that 700, which PUE adjusted is 540. So very clear to me that you're going to overbuild these data centers.
All right, so just taking that, I think you made it pretty clear, but for some of us that are a little less familiar with some of the gigawatts, terawatt hours, whatever it may be. So we have, through the end of 2030, estimates indicate we need about 50 gigawatts more of power to fuel this AI data center boom, right?
Exactly.
The utilities are saying they have commitments of effectively double that, or 100 gigawatts of new build in the pipeline through just the next 5 years. That's probably a more accurate figure than trying to go out 10 years, for which we have fewer estimates.
Exactly.
Okay, so that sounds like an issue, and I think we're going to get into that. Maybe the third parties that are producing these estimates are slow and taking their time raising their numbers, as this has been an extremely fast growing development really across the whole AI ecosphere, if you will.
So yes and no. Obviously, consultants could always be behind the game a little bit, but I really doubt it. A lot of these consultants are inherently too bullish, not bearish. If you want to go build a merchant data center, you're going to hire a consultant to tell your board of directors that there's demand for this. So these consultants are usually too bullish, not behind the curve. I'd also point out, owing to DeepSeek and other efficiency gains, you've actually seen these demand figures come down a little bit. So the efficiency gains of DeepSeek weren't 20, 30%, they were 20, 30 times. And DeepSeek just announced some new models actually yesterday or 2 days ago. So we have not seen these third-party estimates keep going higher and higher. You've actually seen some come down. And again, these are well-staffed organizations, major investment banks. Bloomberg New Energy Finance, they're out at 80 gigawatts for 2030 and just 106 for 2035. The figure I said consensus centered around Deloitte is 165. So we don't think that that's going to be the case, that these are just behind the actual curve.
So if there's any structural risk to the estimates, it should be to the high side, not the downside. So there seems to be a clear disconnect. So but let's turn this back to utilities, and for our listeners that are core Andy DeVries fans, let's get to the utilities themselves and credit quality. So the utilities index is about 950 billion of the ICE B of A. That's about 10% of the overall IG index. Should we be worried, for me as an investment grade strategist, about this becoming an issue for the entire market?
No. So we were very, very pleasantly surprised to hear these utilities talk about the importance of putting in place these rates to protect ratepayers from the risk of these data centers shutting down early.
And wait, so ratepayers just being you and me that use utilities to heat our house, correct?
Exactly.
Okay.
So putting in place these new rates, these new tariffs for data center customers, it used to just come up on conference call Q&As, maybe like buried one line in the 10Q, but now these CEOs are sort of opening their presentations talking about it. Wisconsin Electric CEO, he gave a 25-minute presentation, and it came up 5-6 times the importance of this ratepayer protection, and he walked through several aspects of it. So we were very pleasantly surprised to hear all this, and that's why we think utility investment grade credit quality is very strong.
Okay, so we're safe there, at least from a high level. That's your view now. Can you kind of walk us through how an overbuild situation could impact credit quality if these ratepayer protections are not in place?
Sure. So, and again, like we're bondholders, our upside is par, right? So like we're always focused on the downside here. So the scenario would be you build this large, expensive data center, the utility spends a lot of money connecting it to the grid, and then the data center shuts down early. And then the utility says, hey, we spent all this money. We need not only that money back, but 10% ROE on top of that. We're going to go to overall ratepayers, rate base, and where residential customers pay twice as high a rate. We're going to collect it from you. And then that creates political risk that mom and pop are bailing out Mark Zuckerberg and Jeff Bezos. And then you could have regulators or politicians or both come back and clip the utilities ROE. They could do something that hurts credit quality and hurts credit metrics. And to quantify that, the utility capex to connect a large data center, PPL has said previously it's around $100 million per large data center. That's rural Pennsylvania, cheap land, free land, cheap labor. More expensive Pacific Gas and Electric, Northern California, very expensive land, very expensive labor. They're saying it's $200 million per large data center. So this is new substations, putting up new transformers, putting in place, a stronger transmission cable. All those things cost a lot of money. And that's what's driving overall utility capex up to $215 billion this year. 5 years ago, you were, $50 billion below that.
Wow, some of these numbers are pretty staggering, and I guess when you frame it in some of the hyperscaler tech capex, maybe it's not as surprising. But sticking with the utilities, what are the protections that they are putting in place today? What are some of the management teams? What did you hear them talk about at the conference a couple weeks ago?
I'll tell you about those protections, but you just mentioned, relative to hyperscaler capex. It's interesting because the cost of a new combined cycle gas plant is up to $3,000, $4,000 a kW, and everyone like me who's been covering utilities forever said this is ludicrous. It used to just be $1,000, $1,500. How is anyone paying $3,000, $4,000? But in terms of the hyperscalers, they're paying $30,000, $40,000 for that same kW data center capacity. An extra 3-4 for the power is like nothing. So they don't care about paying that extra money for the power. And it's very important to frame it in terms of the hyperscaler. And it also works for dollar per megawatt hour. So forward power is, $50 and the hyperscalers are paying 90. People are saying, that's nuts. Is it? It's de minimis to those guys. Anyway, back to your question. The protections they're putting in place is various things. So collateral posting for connection requests. So the utility doesn't spend the work, and then, oops, we're not actually going to build it. Stated ramp periods. So we're going to use 100 megawatts this year, 200 megawatts this year, 300 megawatts next year, whatever it is, a stated ramp period. And then minimum volume commitments for a certain time, 10 years, 5 years, 12 years, whatever it is. And then early exit fees. So it's either a minimum volume commitment or an early exit fee. Either way, the data center shuts down, you get paid. Wisconsin Electric CEO is saying full recovery of utility spending if the data center shuts down or runs below expectations. And that's what we heard over and over from these utilities. So we were very pleasantly surprised to hear all of that.
So how is that structured, I guess? Is that just signed into the agreement when they say, we want to build this data center and connect it to your grid? Is that...
Yep,
yeah.
So the regulators, it varies by state. The Georgia Public Service Commission told investors a little while ago they want to sign off on the next 10 large data centers that Georgia Power signs to make sure they've got those protections, i.e. they didn't specify anything. Whereas the Virginia regulators, just a couple weeks ago, they put in place specifics around that, how many years you've got to run, the exact amount you've got to post, the minimum volume commits, everything. And so not just every state, every service area in every state is different, but you're seeing that across the board for the most part.
Okay. And so I think in the report you had done a screen of those ratepayer protections. Is there any more detail in there kind of by region that you think is important for our listeners?
I'm impressed you read our reports, Zach.
I read all of them.
Yeah, I bet. Diego, back in the office here, he ran a screen. So we looked at states where the electric bill was over 2.5% of median income for the state. And then we screened that against service territories with significant data center growth, and then against states where we actually haven't seen ratepayer protection emerge. And so what you saw is Louisiana and Tennessee were the worst, and Texas was not far behind on that front. On a positive note, the Meta campus in Louisiana does have those protections. But that's the screen, and clients can reach out to it. It's constantly updating. So like Virginia just had their rate case a couple weeks ago. That just got updated. It's a work in progress, as they say.
Okay, so it seems like the group is in good shape other than maybe a few states, but I know you've spent a lot of time in much of your research talking about counterparty risk. Can you take us through your views there?
So counterparty risk is a potentially large issue here. So I talked about the importance of putting these rates in place. Meta is building the $30 billion Hyperion campus in North Louisiana. And so they've actually got these ratepayer protections there. But the issue is if that data center shuts down early, who is your claim against? Is it against Meta, sterling A-rated credit quality? Or is it against Blue Owl? Because Meta put this off balance sheet. They said, we don't want to own this. So Blue Owl owns 80% of it. Meta only owns 20%. So if that becomes the new norm and these large data centers start going off balance sheets, these special purpose vehicles, who's your claim against? Big tech or the SPV? Obviously, there's drastically different credit quality between those two. So in the case of the Meta one, you actually do have a claim against Meta. So Entergy Louisiana would have a claim against Meta. But again, you got to read these docs, huge documents to see that you've got that claim. We all know what happens in both bullish credit markets. All of a sudden, that claim goes away, and then the utility's on the hook. And that is still not being talked about at this conference at all by anything. And then Jordan Chalfin, obviously in our Chicago office, covers Meta, but does raise a question: why does Meta want the state-of-the-art, top-of-the-line data center off balance sheet? Is it just to keep the huge depreciation expense from flowing through your income statement? There's obviously a huge controversy over the shelf life of these chips. Or is it because they might want to walk away from that? And no one knows. Only Mark Zuckerberg knows. But that's definitely an issue investors should be paying attention to.
So I think that is a huge issue. And maybe this is more of a question for Mark Leitner on our legal team. But so if the claim is against the SPV, 80% Blue Owl, I guess maybe Blue Owl sets up a separate fund to finance this, and 20% Meta, can they just bankrupt the SPV and say, sorry, Mr. Utility, you're on the hook. Good luck. God bless.
I don't know definitively, but I can nearly guarantee your claim is not against Blue Owl down on Park Avenue over there. It is against some shell company registered in Delaware with no assets. And I'm not picking on Blue Owl. Kudos to them. I do the exact same thing. But that's clearly the counterparty risk.
Do you have any sense of how many data centers up to this point have been financed this way?
The Meta one's the biggest, 30 billion. Vantage is doing another big one with an SPV, and then I think QTS, which is owned by Blackstone, is going in that direction as well. But again, we've only really started the big new wave of these gigawatt size data centers. So time will tell on that front, but that's what we're looking out for.
Okay. And so last one on this point, not to belabor it, but if, let's say, worst case scenario, Facebook, Meta, whatever, decides they want to walk away, and the utility is left holding the bag. What I know you mentioned the ratepayer protect, like just take us through that kind of worst case scenario, just from a high level, how you're thinking about it, assuming does not become a pervasive issue across the industry.
Yeah, so just to flush it out again, you spent the $1 billion. The utilities spent $1 billion. They need to recover that billion plus their 10% ROE on half of it, 50-50 debt equity. So you got to recover that, billion 50 or however many years you want to go out. So data center shuts down. You're going to say, oh, well, I got to recover it. I'll put it in rate base. And rate base, you've got residential customers that pay a rate regulated by the Public Service Commission. And that's going to have to go up, the rate you're charging, to hit that same ROE because data center's not paying it anymore. And then the reporters catch wind of it, and the consumer advocate catches wind of it, the attorney generals catch wind of it and say, hey, this is no go here. Why should mom and pop pay for this data center? And then it leads to lower ROE, a clipped CapEx, however they want to do it. And then that would lower the FFO to debt metrics. So if you look at the utilities with the lowest ROEs or the lowest equity components, they're the ones with the weakest FFO to debt, and lo and behold, the lowest ratings. So that's how it would sort of flush out. That's how it would play out. And then if you have the rates in place, the utility is going to make the claim against the data center and say, hey, you've got to give us that minimum volume commitment. You've got to give us the early exit fees. And that's where it comes down to what we just talked about. Is that claim against big tech, who has the money in the balance sheet, or is it against some shell company registered in Delaware?
All right, so that could get messy, but we're probably a few years away from seeing any of that play out. But back to the data center overbuild story, what other signs are out there we might be overbuilding these things? What other indications do you kind of look at to assess, let's say, the degree of overbuild risk outside of the simple math we already went through?
Yeah, just back to your timing before, this is not a months, quarters, years. This is like a 5-year out risk. Like by no way, shape, or form is this a risk we think is going to start emerging. But hey, these OpCo utilities issue a lot of 30-year bonds, so it's something you have to pay attention to.
That's right. So does the U.S. government, but that's a separate issue.
They have a printing press, but
that they do.
So the overbuilding, like what we're looking at is, the companies with open uncontracted compute. So CoreWeave has a $40 billion market cap. It was $70 billion just a couple of months ago. And that means the equity market is saying, this is a real company. You're worth $40 billion. This is a real company. It's going to be around for a long time. The bond market is saying, we want 11% yields for 5-year paper. Maybe you're not a real company. So that's what we're looking at. We're looking at these disconnects here. And the stock market and the bond market, that's a pretty big disconnect. 40 billion market cap versus 11% yields. You don't see that very often, as you know. Eric Vega, our data center analyst, he just put Equinix, which is again a data center company. They have a little more contracts than a CoreWeave, but he just put Equinix into our U.S. investment grade best ideas report as a pan. So that's interesting. I would also highlight our best ideas report did go out today. We had 12 picks and 6 pans. So shout out to the investment grade team for getting that out. We've outperformed for 8 of 8 quarters on the long side, 2 years in a row, and 6 of 8 quarters on the short side. So clients should definitely reach out to check out that report.
All right. I love that I didn't even have to tee that up for you. That worked in very nicely to the conversation. Big shout out to the team. Love to always have that in my back pocket going into client meetings. So what else? Is there anything else that you're looking at? Maybe are there any positive signs or any, I'd say, risks in the other direction in terms of this not being an overbuild situation and the potential that maybe we'll need even more capacity? Or
I mean, we're doing our homework. We're doing the work everyone else is doing as well. We're paying attention to everything, all the interviews. I mean, I feel like it was kind of embarrassing when Sam Altman of OpenAI was on a podcast or a webinar a couple weeks ago, and one of the VCs asked him about the fact that they do $20 billion of quarterly revenue and they've got $400 billion of CapEx commitments. which is a logical question a CEO should be able to answer. And the guy had a temper tantrum like he was a little baby. He's like, oh, do you want to sell back your stock? Do you want to sell your shares? Like, that is a legit question a CEO should be able to answer. So, I mean, kudos to Sam Altman, but just couldn't answer that question at all. So that's worrying. And then the other thing to like measure this growth is we use AI agents to measure AI agent growth. So we've got an agent working in the background, vacuuming up third-party estimates of demand from data centers. So we're always paying attention to these third-party, estimates to the extent they come out from the consultants. A lot of them are free. Some of them, the paid consultants like Gartner's out there. They're out there with terawatt hours. We use gigawatts, but on the terawatt hours, our 85 gigawatts comes out to around 770 or so terawatt hours demand for 2030. Gartner is out with 900 terawatt hours for 2030 for the whole world. And so that just came out last week. So we're using AI to measure the AI, and our agents pick that up. And then we're also paying attention to, the DeepSeeks. They just announced a new version, a new update earlier this week, much more efficient. And then small language models, they consume significantly less power. And then we're also paying attention to these ASIC chips. So investors should be very cognizant of the fact that big tech's CapEx, which everyone's laser focused on, could actually roll and start coming down, but power demand could keep going up. Because to the extent you use more ASIC chips rather than NVIDIA's expensive GPUs, power demand could still go up even as CapEx comes down, because these ASIC chips are significantly cheaper, but they don't consume a whole lot less power. So those are the things we're looking out for in our trade pubs. As I said, we've got AI agents updating us. And then obviously we talk to clients every day and hear what they're hearing as well. So we're staying on top of this stuff.
Yeah, that sounds like an understatement. And frankly, some of it is still outside my realm of full understanding. I'm still kind of ramping up. In terms of the Sam Altman interview, I don't want to belabor that point, but so basically he got asked the question that I've certainly been wondering. I know that Andy Lee kind of throws around these numbers of 20 billion in revenue versus 55 billion in commitments over the next year. Like there's a 35, and that's revenue. That's not even that doesn't even include other expenses. And he didn't answer it at all.
He told the questioner right away, do you want to sell your stock back to us? I could find a buyer. Do you want to sell your stock? And then near the end of the interview, he just left. So it's like, time to have an adult conversation here, like an adult conversation. Let's do it. But he didn't. But again, He's Sam Altman. The guy's worth tens of billions of dollars, and I fly Delta Comfort. So we're in a different playing field here.
All right, that's fair. We don't have to. That seems like a very concerning response to an extremely reasonable question. But I guess we're just kind of entering uncharted territory in a lot of ways with all of this. Okay, so is there any good news from your perspective that we can maybe close on as we're getting kind of through to the 30-minute mark here?
Yeah, as I said, you definitely got some strong growth here. And while I'm sort of highlighting things the utilities have to look out for, the IPPs, the independent power producers of the world, the NRGs, the Vistras, the Talons, these guys are in great shape, because even if that 2030 figure isn't 85 gigawatts, even if it's 65 gigawatts, even if it's 50 gigawatts, you've only seen 10 to 15 gigawatts of long-term supply deals be announced. And we do think you'll see another 10 to 15 gigawatts in 2026. Constellation is the obvious play here. Their EV to EBITDA is 2 to 3 times more, 2 to 3 points above where the NRGs and Vistras of the world. So Constellation's around 14 times, NRG and Vistra around 10, 11 times. And that's because the market is baking in more of these deals. So right now you're selling in forward power into the market in the high $50 a megawatt hour range, and big tech is paying in the $90 range. So you get that huge uplift with essentially no additional cost. And so that's the good news there. Constellation's the obvious one. Everyone's expecting more deals there. Vistra Energy, and we just put Vistra secured bonds, low BBB, into our investment grade best ideas report. They only trade 10 bips inside NRG despite significantly better leverage, while NRG's taking leverage the other way to do an acquisition. So anyway, we think Vistra's got some upside there. They announced a deal at their Comanche Peak nuclear plant in Texas. That one's $95 a megawatt hour. They have some other nuclear plants in Ohio. We think you could get a deal there. They've been talking about getting to investment grade at the unsecured level for over 5 years now. People essentially laugh at it. But recently, we've changed our view that think actually have over a 50% chance of getting there. 3 reasons is A, Constellation has that EV to EBITDA premium. 2, they changed their aspiration from investment grade metrics to investment grade ratings. And 3, a little more qualitative here, NRG and Vistra are fierce competitors in absolutely everything they do. Everything. So NRG is levering up to do a $12 billion acquisition entirely debt financed. Vistra is not. Vistra could actually rip the Band-Aid off, use their free cash flows to reduce debt and get down to that leverage. NRG can't. So if you're fiercely competitive with someone and the equity market's giving you a higher EV to EBITDA multiple premium, I think this is the time to do it. So that's why we like the Vistra debt stack right here. So that's the good news. Yeah, that's the good news. The IPPs are in good shape here.
All right, a lot of interesting takeaways there for our audience, particularly our utilities investors. And so we can't end this podcast without talking about Trump. And this is something that I think is going to become topical broadly over probably not the next couple months, maybe over the next 6 months. The midterm elections. But you recently wrote about, power bills potentially becoming a midterm election issue and what Trump can and can't do. Can you refresh me and our listeners your views there?
Sure. I'll try and keep it short and sweet here. The PJM capacity market, so the Mid-Atlantic region, prices there, this is where you're paying power plants that don't make enough money producing energy. You're paying them to not shut down, and you're paying to incentivize new generation. So the PJM capacity market just a couple years ago was, $29 a megawatt day. That skyrocketed to $270 a megawatt day to $330 a megawatt day, and there's another auction taking place in 2 weeks. This capacity auction has added $20 a month to New Jersey customer bills. I think you can see New Jersey out the window if it wasn't so foggy out here. So what we saw for the elections a couple weeks ago is these power bills are becoming a real election issue. So if the midterms approach next November and power bills are still an issue, I think you've got to be prepared to waking up to Trump doing something crazy. I mean, this is what he does, a tweet or whatnot. So utilities are obviously regulated at the state level. He doesn't have as much say, but we know from Trump 1.0, the last time he was president, he can use the Federal Power Act to force the FERC to intervene in the PJM capacity markets. Interestingly, Trump 1.0 did exactly that to raise the PJM capacity market price. You were plumbing along owing to cheap shale gas down there around $20, $30 a megawatt day. He wanted to bail out his coal and nuke friends and put in place the minimum offer price. It didn't work too well, but at least set the precedent that Trump can instruct the FERC to intervene in the PJM auction. So if power bills are still a big issue in the midterm elections next November, which I think they will, he could go the other way, use the Federal Power Act to intervene in the PJM capacity market to lower bills. So you wake up to some tweet saying he's instructed the FERC to intervene here, and then there's risk on the PJM capacity auction front. And in the IPP space, Talon, which is in great shape other than this, they get around half their earnings from the PJM capacity auction. So let me just flush that out in case people missed that. Half of their EBITDA is going to come from costless revenues from the PJM capacity auction. So maybe there's some risk there. It's why we favor Vistra, which has a lot more Texas exposure, which doesn't even have a capacity market. That was a long answer to your question on Trump, but that's how we're looking at it.
That was impressive. I want to start by apologizing to our non-utilities listeners that might not have been able to follow along. I'd put myself maybe in that camp, but I think for those that know the lingo, I think that's an incredible breakdown of kind of how you're thinking about the haves and have-nots in some of these risk situations, and that is just a kind of microcosm of everything we went through here, Andy. So I think we covered a lot. Maybe we'll have to have a follow-up podcast, maybe bring on Eric Vega on the data center side, maybe get Jordan and Andy Lee on the tech side to bring this all together. I think you guys are doing a panel at our Outlook conference on December 11th in New York. Is that right?
Yep, absolutely.
Any clients that are happen to be listening and haven't gotten information about the Outlook conference in New York, feel free to reach out to me directly or Andy, and we'll get you the information. But I think, Andy, we covered a ton there. It was an awesome discussion. I really appreciate you coming back on the podcast.
Cool. Thanks, Zach. Thanks for having me.
All right. And thank you all for tuning in. We'll catch you next time on No More, Risk Better.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.